Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, November 3rd, 2025. So, economic data from last week, we go through that every week. We're doing the podcast, we review what happened the week before, but as we're now 30-some days into the government shutdown, we have very little new economic news to work from. A couple of housing data points from last week, which really didn't move the market. Housing price index a little better than expected. Pending home sales a little worse than expected. So that was nothing, really. But the only economic news really from last week was the Fed rate decision, which came out on Wednesday. And as expected, it was priced into the futures market, 99% probability. The Fed did indeed cut the discount rate by 25 basis points to 3.75 to 4.0. So that was good. However, during the speech afterwards, Jerome Powell put a little bit of cold water on the expectation that we'll definitely get another rate cut by the end of the year. We'll show you those probabilities in a moment. So that data point, we did get what we expected, but then got a little bit taken away. So we'll take a look at the futures and see how that impacted the market last week. But other economic news, or just an update, third quarter GDP has not been announced yet. Of course, with the government shutdown, not sure when it will be. However, the Atlanta Federal Reserve does believe we had a very, very strong third quarter. They still stick by their expectation for GDP growth during the quarter of 3.9%, well above what most economists expect to come in at. The consensus is probably closer to 2.5%, but Federal Reserve still sticking by the 3.9% expectation. In terms of inflation expectations, hardly moved last week. Since we haven't updated this in a while, just to let you know, the Fed funds future market has priced in a 2.3% expectation. That's the break-even number for the next 10 years of average inflation. Now, Fed funds future market, in terms of expectation for future cuts, December's the next FOMC meeting. Now, that was pretty much priced in that we would most definitely get another 25 basis point cut. But again, Jerome Powell, during his speech after the rate announcement last Wednesday, really simply discussed the fact that it is not a definite that we're going to get it. And obviously, inflation is not even close to the Fed target of 2.0. It's closer to 3. And we really don't know what's going on the employment front. The labor markets have weakened, but we really don't know what the numbers are. So Jerome Powell just simply stated we may get another rate cut, but it's not a definite. So the expectation has dropped dramatically. It was priced in at 99% probability we would get that second rate cut in December. That has now dropped to 67% probability. Now, one thing we did get last week was corporate earnings. We're right in the middle of it. So when I say the middle, 64% of the S&P 500 companies have reported, and it has been a stellar quarter of reporting. 83% of companies that have reported have beat expectations. That's well above the 5-year and the 10-year average. So that's all good. The one thing I will mention, though, is that the magnitude of the beat hasn't been quite as much as what we've seen in the past. So it's a little below the 5 and the 10-year averages. But nonetheless, the percentage of companies beating is as high as we've seen in a long time, number one. Number two, the expectation now for full third quarter earnings cycle, again, 62% have reported. But the expectation now has risen that we expect a 10.7% increase after all the companies have reported for the third quarter. Just a week ago, that expectation was only 9.1%. And if you take that back to the beginning of this quarter, September 30th, it was only 7.9%. So why the big jump? Largely last week was the Magnificent Seven. A number of them reported, and in particular, Amazon results were really good. So that really led the market forward. So we'll just segue into that in terms of returns last week. U.S. equity market up the S&P 500 up 70 basis points last week. But when you unfold that, take a look at what drove that. Magnificent Seven, those names on average were up 2.9%. So the Invesco equal-weighted S&P, while the S&P was up 70 basis points, the equal-weighted was down 1.7%. So all the returns last week and then some in the U.S. came from the Mag 7. So small cap was down last week 1.4%. Tech was up, of course, Magnificent Seven, but value down on the week almost 1%. Small cap down 1.5%. So clearly Mag 7 driven week last week in terms of U.S. equities. In terms of international, it was mixed. Developed markets ex-U.S. down 40 basis points. Emerging markets, though, up nearly 1%. So the gap now between developed markets ex-U.S. return on a year-to-date basis and the S&P 500 has narrowed considerably from what we saw about 3 months ago. So S&P now, year-to-date up 17.5%. Developed markets ex-U.S. up 22.9%. Fixed income last week gave up some of the gains that we've been seeing. It's been really just a super strong year in total for fixed income. The Bloomberg U.S. aggregate gave up about 60 basis points last week, still up 6.9% year-to-date. But last week, the 2-year yield and the 10-year yield both rose. 2-year up 8 basis points, the 10-year up 6 basis points. Now, in terms of economic announcements this week, again with the government on hold, not really sure what we're going to get in terms of data points. Today, we're expecting, this one will be released, the ISM Manufacturing Index. That 50 is a demarcation line. We talk about it a lot. For the month of September, it was 49.1, so just slightly in the contraction area. It's expected to come in for the month of October at 49.5. We'll have ISM services on Wednesday. That's last month was right at 50. Month of October is expected to be a little bit better at 50.7. Now, I'd say the key number that is expected this week probably is the ADP employment change number that comes out. The October number comes out on Wednesday. Since the BLS, Bureau of Labor Statistics, has not been putting out the non-farm payroll numbers, people have to rely more on this as a gauge of labor market strength. So the expectation for the ADP change is that we will have added 24,000 jobs in October. The September number was a really poor negative 32,000. Now, in terms of Friday, we'll get the Michigan Consumer Sentiment number. That has hardly moved the markets at all lately. The number for November is expected to be 53.2, really in line with what it was for the month of October. It's still on the calendar, the non-farm payroll number for September. We haven't got September's number, so I'm not sure if they're going to release September and October at the same time, but it's still on the calendar for release as of Friday. But again, with the government shutdown, I doubt that's going to happen. So all these numbers, non-farm payroll, non-farm payroll private, average hourly earnings, unemployment rate, probably not going to get those on Friday. So that's the best we can do with incomplete information. So that's a wrap up of the economic activity last week, preview for this week, and how the markets did last week. Thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.